Hello and welcome to Ilanomics. We are back with you once again on a weekend, on a Saturday evening, and that is because yesterday was Holi, and I apologize for this 8-minute delay in starting on time because it's the day after Holi, and even technology is still reeling from the after effects of Holi. But now we are on live, and we'll go straight to what we are supposed to be talking, and that is inflation. Inflation is something we keep talking about on this show very frequently. Every other week, inflation somehow creeps into our conversation. Last year, when we were talking about inflation, Ela kept saying this is supply side, this is transitory, it will go away, it's part of a post-COVID recovery, so not to worry. But the inflation has become sticky and things are only getting worse. So we will tackle that question today. What has to be done and what can the RBI do? Because RBI is the main agency or the main government autonomous body whose basic purpose is to tackle, contain inflation as part of the monetary policy. Welcome, Ila. Why are we talking about inflation? Why has inflation become a worry again?
So the first thing is that inflation has risen, and not just in India, but in the rest of the world. And the main question that is facing all central banks is that while this was a time when they thought that they would slowly start normalizing monetary policy in the post-COVID phase, because they had been one of the instruments to tackle the pandemic and its impact on the economy had been loose accommodative monetary policy. At this time, when central banks had thought that they would start tightening slowly, suddenly what's happened is a very sharp increase in inflation. We do understand that part of it, a lot of it is because of the war in Ukraine. And that raises the question, should central banks do something about it? One could argue that this is supply side inflation and, it's supply side. And so why should central banks do anything? Would there be an adverse effect on the GDP growth, which had just started picking up? Would it be hurt if central banks were to start normalizing faster because of the shock to inflation than they were planning to? So it's, a question that keeps coming up in every discussion about what lies ahead for the economy. And that is that with this sudden sharp increase in inflation, should central banks start responding? And that's why we are back on this topic.
So can we talk about what is contributing to this spike? 6.01 in January, 6.07 in February, which is 2 months in a row above the outer limit of the RBI's 4% band. So what is contributing, Ila? Because petrol prices and diesel prices have been stable for since the 4th of November.
So, this time it's also many other factors, broadly commodities, things like wheat, edible oil, because, so for example, sunflower oil, which we import from Russia and Ukraine, and 90% of which we import from Russia and Ukraine. And when those supplies get disrupted or people believe that there are going to be shortages in the future, then there's pressure on other oil prices as well. So this time, the inflation that we are seeing is not just petrol and diesel, that it is more broad-based. And if you look at inflation in other economies, they're also seeing core inflation pick up. And the US particularly has started seeing a very sharp increase in inflation, way beyond. So at 8%, way beyond what their 2% target allows in the economy. And there are, of course, they've raised rates, but then there are people saying that demand has contributed, because the US has done a lot during COVID, during the pandemic. They did a lot of fiscal transfers and kept consumer demand high, while at a time when there were supply issues. So their expansionary fiscal policy has actually led to higher demand. And so now the question is, are they behind the curve? Are they, with higher demand? If inflation is demand led at a time when there's also a supply shock, then is the US Fed slow 0.25 trajectory of an increase in interest rates enough, or should they be doing much more?
So coming back to India, would you categorize our inflation as still supply side, or it has also become demand side?
You see, it's not always a very clear where one can say that this is only a supply side issue, because at this time, the economy had started picking up. So while predominantly we know that there are supply side issues, especially because of the war, but we also know that because of the sudden sharp pickup in economy, what happens when the economy picks up, which it has been doing post-COVID, when government is planning to expand its expenditure, when construction activity is coming back on, is that demand for products, for commodities starts increasing. And if at that time there are suddenly supply constraints as well, then that puts pressure on prices. So I wouldn't say that it's only supply side, because we have seen higher GDP growth come back with the, hopefully the end of COVID, certainly with the end of the third wave and of Omicron.
There is a connection between CPI and WPI, and you talked about how in your column, which was published this morning, which is going to be there in the details of this video, WPI has spiked to 13.11% in February, which is the 11th consecutive month of double-digit inflation. And WPI contributes to CPI. Can you explain that connection for our viewers?
So WPI is the wholesale price index. It is not anybody's consumption basket. And so the weights in that wholesale price index are different from the weights in the consumer price index. Actually, WPI is a strange construct, which is particularly Indian, where we don't really have a corresponding index like this in other countries. What they have is more like a purchaser price index, or a producer price index, where they look at the basket that is purchased by producers. But a wholesale is not typically what other people use. So what's the difference here? The difference in India between the two is that the weight of food, the weight of housing, rent, and many other items which are consumed by the consumer are in that CPI basket. Not the weight of food is lower in the WPI basket and higher in the CPI basket. What does the CPI represent? It represents the consumption basket of an average consumer. Not that there's anything exactly like an average consumer, but you work out what people on average consume, rich and poor put together, rural and urban put together, and that gives you either an urban CPI or a rural CPI. We could of course look at different sections of society, but basically the CPI. Now the connection between the two is typically that the WPI often rises faster in terms of time. That first comes the increase in the wholesale price index. And we see that being passed on in commodity. When what we're seeing now is the rise in commodity prices. And if that sustains for a long time, then producers push that through to retail prices. So that historically the connection we've seen is that there is an increase in WPI and that gets transmitted to the CPI. Now, this is not very interesting for the average consumer. It's not very interesting for the average listener, I'm sure, for the viewer. It's more interesting for, people like us who sit and try and figure out, is the CPI going to be high, remain high, become higher? And therefore, does monetary policy need to respond to it in some way or the other, or can it just say that, okay, this is very short-lived and will go away, like we were saying last year?
But I think our viewers, more than the experts, would definitely be interested in the outlook for domestic inflation, where you have talked about things like sunflower oil imports, which come from Russia and Ukraine, which is 90% contributes. These two countries contribute 90% of India's sunflower oil imports. There is fuel in the pipeline, which, at some point of time, the government has to allow the oil companies to increase petrol, diesel prices. So the domestic inflation outlook, what is it for you, Ila?
Yes, so it is not, it's expected to remain elevated. So whether it is 6%, whether it is 7%. Now the reason why we are raising this question is because the RBI's forecast is 4.5. Okay, and that's what the Fed has also done, for example, that it's kept its, central banks, we kind of tend to believe what central banks say because they're all this, they have a lot of gravitas and they have a lot of, credibility, and we tend to believe them. But when they come up with an inflation forecast that is lower than what almost anybody expects, then it's very damaging to policy. And it's not just the RBI, it's the US Fed doing a similar thing. So I think the point we're trying to make here is, look at the inflation figures, and can RBI please revise its inflation forecast, because it is critical that the central bank remains credible. If the central bank starts losing its credibility, whether it is the RBI or the Fed, if they start losing their credibility on inflation, and people start thinking that, inflation is going to be higher than what the central bank is saying, and that the monetary policy is not oriented towards trying to control it, then it starts getting into inflationary expectations. And of course, that has consequences both for things like wage setting, price setting, as well as the currency. And therefore, so the connection is that we're trying to raise this question of, we're talking about inflation to show you the facts and to show you that it is difficult to believe that the forecast that has been made is a credible, by RBI, is a credible forecast. And so it's high time that they start looking at the reality.
So I get the impression that the onus is a lot on the RBI. You talk about, of course, the forecast, and make a change in your forecast, lay down a clear path of normalizing policy. Why is the onus so much on RBI?
You see, because other central banks have started raising rates. And then what the RBI tends to do is that it tends to start focusing on the currency. And because the mix of macro conditions becomes very, it can create a lot of instability if you don't recognize what is happening. Then you start doing things which are like knee-jerk reactions, and you do things, in a panic situation, which can actually hurt the economy much more. So the reason why you worry about inflation, the reason why you worry about macro stability, is not because it gives you higher growth today and tomorrow, but because that sets the conditions. A lower and stable inflation sets the condition for higher output growth, because people invest when there's more certainty. if there's a lot of uncertainty, people don't invest. So in this case, for example, suppose you start thinking that, oh, our inflation rate is very low and is going to remain low, whereas the market, participants, everybody else thinks that your inflation rate is going to be very high. And let's say that other central banks, in response to, so the rates are higher everywhere, and other central banks start raising their interest rates, and you don't. Now, what happens? Already capital has been, portfolio capital has been leaving India. Part of it is that their returns are higher. Part of it is expectations of what will happen to the currency, particularly since we are a large oil importer. So we expect to see a large current account deficit. We have higher inflation than we are willing to admit. We have lower interest rates because we are not willing to admit that we have higher inflation, and we keep them low. And let's say capital starts flying out. It is already leaving, but suppose this speeds up. Typically, then you try to step in and start selling your reserves because you try to defend the currency. You say that you want to smoothen out volatility and you try to defend the currency. The message that market participants get is that this is a currency that is not at its true value. With this higher inflation rate, larger current account deficit. And then when they see the RBI trying to defend it, they also think that, oh, this is a short-term thing. It could be that they stop defending and then the rupee will depreciate. And that's when, capital starts going out, and you also start doing panic reactions like raising rates too much. So just looking at what is the reality, accepting it, even if the RBI was to say that, okay, inflation rate is higher, but these are the reasons why it is supply side, why we predict that it's 4.5 is their forecast. But instead, these are the reasons why we think it's going to come down. And therefore, this is going to be our pace of normalization. Just kind of reality check and being credible is critical, is absolutely critical at a time like this. So that's what we are arguing.
Let's take some questions now, Ila. Quite a few of our viewers waiting to get your answers on a Saturday evening. First one is from Sajal Jain. Simple question. Please explain the difference between inflation or how it is calculated in India and the US. Is it the same?
No, it's the same. Inflation is the rate of growth of prices.
No, the basket maybe?
The basket is, our average consumer's basket versus their consumer's basket when you look at the US rate. So they sometimes deseasonalize, right? They may give you deseasonalized data. I'm sorry. But otherwise, not very different.
The next question is from Sankalp. Sankalp is a regular viewer, I think. With the war and COVID progressing, increasing uncertainty over supplies, do you think it will be prudent for the RBI to make changes in policy? Should unemployment be a focus? Are you discarding the Phillips curve?
Oh, you see, when RBI is given the mandate of controlling inflation while being mindful of growth, then basically they're being told that you have to control inflation. Of course, don't do things that are, very, very bad for growth. But see, as I said, fundamentally, you need a view, a little longer term view, where you understand that having high and volatile inflation is not good for employment growth. It might, so the Phillips curve might tell you that in the short run, there is a trade-off, but the same trade-off doesn't carry through you can't into the longer term, you can't inflate your way to higher growth. You can't. So it's not ignoring the Phillips curve. It is understanding the fact that the Phillips curve is very, very short term, and that if you start getting high inflation, it's not that you'll keep getting growth. I mean, the countries which get very high inflation don't get high growth. In fact, one of the things that a lot of people are worrying about, there's an article by Larry Summers recently, and following a research paper that he has done, where he's saying that typically such periods are followed by a recession. So if you get very high inflation, you don't get like, okay, now with high inflation, we are set on a path of high growth.
And is that what is called stagflation?
So stagflation would be when you have both high inflation and low growth, and you could well slip into it if you don't control your inflation.
In fact, that word has been frequently used in the Indian context as a fear in recent times, but we'll keep that for another time. Prasoon has the next question. First of all, is there a difference between rural and urban inflation? And if there is, what is the difference?
So you see, typically when the baskets are a bit of rural and urban are slightly different, not terribly different, but slightly different. One of the big differences is rent. So housing in urban areas is usually rented, whereas in rural areas, people typically have their own houses. So that is typically the difference that you see. Otherwise, slightly higher food and lower transport. So, there's a few small differences in the baskets.
I'm taking a question from Rasik because on Twitter, which is sort of connected to what we were talking about, stagflation. He says, I'm not an expert and I want to check if this is true. The conundrum to reduce or increase interest rates, inflation means less purchasing power. Reducing interest rate helps borrowers. We are in stagflation, less demand, but yet supply side shock of oil and commodities. It's more of a statement.
Sure. Yeah. Stagflation. You see, there is a struggle that every central bank faces when it is a time of high inflation and low employment growth, low growth. This is, it's not, there's no textbook answer to what to do in a period of stagflation, of what to do when you have high inflation with low growth. It's you can only have a point of view. You can only say, okay, this is the reality, this is what it is, and we choose to do X, Y, Z. It's a challenge. It's not easy, and there are no easy answers.
This is Shankar Nanda on Twitter, and first of all, he says, I want to congratulate the Print India for great show. He's a subscriber. Thank you, Shankar. We are also very happy, and it's our privilege to have Ila talk to you about the pressing issues of the day. Shankar has several questions, so I will try and summarize them, and you can all include it into one answer. Ila, he says, how much of the current inflation can affect India's growth this fiscal? If the government cannot boost growth this time, won't it be difficult going into it the next year, and they will have to give a lot of freebies because it's election year? Will private capex come down because of inflation? And how much of inflation can RBI control? Most of it is imported, and the cause is different. So a lot of thoughts there.
Okay. So yes, RBI can only do so much. Any central bank can only do so much. This is a combination of a pandemic and followed by a war. And yes, inflation is imported. And that's why we asked this question right in the beginning. The question was, how does a central bank respond to inflation when it is largely a supply side issue? And as I said, there are no easy answers because, as people would say, look, you can't do anything else about it. But if you look at what if you were to do nothing? So let's, instead of saying that, look, if it's supply side inflation and you raise interest rates, then you are going to make things worse. So that could be a view. And one could say, okay, so don't do anything. And so what if the central bank or the RBI does nothing, does not raise rates, and inflation keeps raging? Now, what seems to be, at least that's what a lot of economists are currently saying, is that there is a risk. And the risk with this strategy of doing nothing would be that inflation could become persistent. It could become, inflationary expectations could rise, and inflationary expectations could become persistent. So it's not the exact impact on demand through raising inflation rates, through raising interest rates. So, you raise the repo rate, you pull down aggregate demand. It's not just that. The question now that could become important is that if central banks were to choose to say, oh, actually, my forecast of inflation is low and I'll do nothing and it's all supply side, then is there a risk of that inflation becoming persistent? And that's the question that you need to ask, not that if it is supply side and if it is imported, should we do nothing? By the way, even for imported inflation, if you create conditions for further rupee depreciation and further currency weakness, then even the imported inflation would become even more, because if the currency weakens, then you get more inflation from the same dollar increase in oil prices. So signaling that you're going to tackle inflation is as important as actually tackling it.
In fact, you have already answered the next question. That was from Sid. His question was very simple. What will happen if RBI does not increase rates for a year? Answered already. I think we have time for maybe one or two last questions, Ila. Prasoon had a lot of questions. We've already taken one from him. Sid has 3 questions and you answered the first one. There seems to be an across-the-board rise in prices, not particularly determined by supply-demand equilibrium. Is there some evidence of cartelization? In the US, a lot of research is being done on this.
I don't know that there is cartelization other than the OPEC oil price. I mean, they could increase supply and that would bring down prices.
Yeah.
Now that we are being told not to buy oil from Iran, from Russia, from this, that, and we are pretty much at the mercy of a cartel, an oil cartel, which has not said that it will increase, which needs to, I suppose, increase supply, and that could bring down prices. I mean, that is very much something that is a cartel. It, well known to be.
Yeah.
On the other, I don't know that what are the cartels here that he's possible cartels here that he is referring to. I think it's more of a general pressure on the demand side and inflationary expectations, as well as logistics and imported inflation.
Last question, Nila. This is also from Sid. Will the increase, if there is an increase in interest rate, lead to higher interest rates on existing loans?
Of course.
Very true. Yeah.
I mean, what does an increase in interest rate mean? An increase in interest rate means that the rate at which loans are given, that rate increases, and the rate at which you borrow or the rate at which you lend. So it's also that when the interest rates increase, then savers on their savings bank account, on their fixed accounts, get higher interest rates, though typically we see a lot of asymmetry in the speed of transmission of monetary policy. So the borrowing rates go up first, while the rates at which for your fixed deposit and what you earn will actually go up very slowly. But yeah, of course, that's what an increase in interest rates means.
We have discussed transmission in the past, and maybe we'll discuss it at some other point again. But I guess, just to add to that answer, Ila, there are those, EMIs or housing loans where you've taken a loan at a fixed rate or a floating rate. So the floating rates will obviously increase, the fixed rates will not increase. And if you have borrowed for a vehicle loan or a personal loan, where the rate was already set at a certain point of time, those rates cannot be changed, can they?
Yeah, I think also my big concern in terms of the macroeconomy is also that the government's borrowing interest burden will increase. I mean, it should. I'm not saying that RBI should be a predominantly the debt manager of the government and worry about that. But yeah, that will also increase. And that's part of what happens when, currently you have negative real interest rates. I mean, if you are a saver, and your inflation rate is persistently 7%, and what you're earning is say 5 or 6%, you're actually not earning a positive real interest rate. So that's not something that an economy can sustain for a long time. It's not something that will encourage savings, and sooner or later, if this persists, savings go down. Or at least savings in the banking sector and so on go down. People start buying gold. Here, customs are all, you pass through an airport recently, you'll see customs standing there, golds being highlighted, them checking where are you coming from, because suddenly you see a flight of capital. I mean, purchase of gold is as good as a flight of capital. You move away from the rupee, you move away from rupee assets. So keeping interest rates very low in an economy, I mean, let's not, of course, the EMIs and those who have variable rates go up. But I think if you look at the macro implications beyond your EMI, then you'd rather that you didn't have such low interest rates. Or at least you'd rather you didn't have negative interest rates, because it does not lead to macro stability in the long run.
I think, which is why there was so much of a heartburn when the EPF reduced its rate for this year from 8.5 to 8.1%. Everybody loves higher interest rates on their deposits. Thank you so much for watching this episode of Ilanomics on a Saturday evening. We are very happy to have you watch us on a weekend, on a long weekend, a holy weekend for us here in North India. We will be back next week, hopefully Friday, not Saturday. And until then, stay safe and see you next week.